The S&P 500 is selling right near all-time highs, and it seems like investors are becoming more optimistic about the stock market in general. Every few months, JP Morgan puts out a great report that covers the key fundamental data of the market and how things are looking. And I love to dive into this data and share it here on my channel. It gives us a good overview of the market and how things are currently being priced, which helps us properly set our expectations and find potential areas of value. So in today's video, I want to share the key highlights from JP Morgan's most recent market update and what my takeaways for investors are. However, before we get into the video, I want to let you all know that this video is sponsored by WikiStock. WikiStock provides investors with accurate, comprehensive, and diversified information to help them identify the reliability of brokerage firms, reduce decision-making costs, and effectively avoid risks. One of WikiStock's core functions and value adds is that they have a Wiki score system, which is a multi-dimensional scoring system for each brokerage. This score focuses on the regulatory aspects, business, licenses, features, and risks of over 11,000 brokerages around the world. They also show you all of the different securities licenses each brokerage has. For example, we can see that Interactive Brokers has 7 licenses in the US, Australia, the UK, Japan, China, Singapore, and Canada. You can also view the pros and cons of every brokerage to see what their strengths and weaknesses are. For example, we can see that Interactive Brokers has low trading fees, a high interest rate on cash, a wide range of products, and many great research tools. However, it also has a complicated account opening process, a complex desktop platform, and understaffed customer service. So Interactive Brokers sounds like a great brokerage for people who can leverage analytical tools, but it also is challenging to set up. So if you're interested in checking out WikiStock and finding the best and most trustworthy brokerages, then make sure to download their free app via the link in my description. WikiStock also has an expo going on in Thailand that will take place in Bangkok on September 7th. The details of that event are also in my description. And with that being said, let's now hop into the video. Alright, so this first chart that we're taking a look at shows us the forward price to earnings ratio of the S&P 500 today and historically. So as of July 31st, we can see that the forward price to earnings ratio was sitting at 20.7. And the previous top was on January 3rd of 2022 when the price to earnings ratio got to 21.4. However, at that time, interest rates were only sitting at 1.6% versus 4.1% today. So basically today, the market is selling for a slightly lower price to earnings ratio, but the interest rate on bonds is significantly higher. And therefore, you could make the argument that the stock market is actually more expensive today versus the peak in 2022. Now, we can also see that the forward price to earnings ratio of the S&P 500 during the tech bubble was 25.2, and at this time, the 10-year bond yield was 6.2%. So this combination of a very high price to earnings ratio and a high yield on bonds does show us that the stock market was incredibly expensive during the tech bubble, and I personally do not think that the market is near tech bubble levels quite yet, and really not even close. But in general, I do think that the S&P 500 is looking expensive today. Now, moving on to the next screenshot, this one shows us the 30-year average forward price to earnings ratio of the S&P 500, which is 16.73. We can also see +1 standard deviation and -1 standard deviation, and a +1 standard deviation is a forward price to earnings ratio of 20. And once again, we can set the market is trading for 20.7 today, which is actually quite expensive. We can also see that there was only 2 times in the past 30 years where the market was trading for this high of a price. The previous time was in the 2020-2021 era, and also during the tech bubble of 2000. And to me, this does suggest that the S&P 500 is looking expensive today. All right, now this next screenshot shows us the forward earnings per share estimates for the S&P 500. And for 2024, analysts are expecting earnings per share across the S&P to grow by about 11%. Now in 2025 and in 2026, analysts are expecting the EPS of the S&P to grow by 15%. So this is what the market, I think, is currently pricing in, is quite a bit of growth over the next 3 years. And this is what analysts are expecting. And as I just said, I personally think that this is a lot of growth that the market is pricing in. And you can ask yourself if you think that the market is actually going to see 15% annual growth over the next 3 years or not. This next chart shows us the value versus growth relative valuations. And we can see that right now, value stocks are looking cheaper than growth stocks. However, if we take a look at this bottom table right here, we can see that the current forward price to earnings ratio of value stocks is sitting at 16.2, and their long-term average is 14.1. So even though value stocks are looking quite a bit cheaper than growth stocks, it is worth pointing out that value stocks are still selling about 10% above their historical average price to earnings ratios, and therefore even value stocks could be argued to be looking expensive today. This next chart is an interesting one because it shows us the price to earnings ratio of the top 10 stocks in the S&P 500, the remaining stocks, and the total price to earnings ratio of the S&P 500 on a forward basis. So the top 10 stocks are currently trading for a forward price to earnings ratio of 31.3, and their long-term average is 20.5, which means that the top 10 stocks are trading about 53% above their historical average price ratios, and again, are looking quite expensive. The remaining stocks in the S&P 500 are trading about 11% above their historical average price ratios, and in general, the entire S&P 500 is trading about 25% above its long-term historical averages. So in general, it looks like stocks in the S&P are quite expensive today. The weight of the top 10 stocks in the S&P 500 is also sitting at 35.7% now, or basically 36%. And really, since about 2016, the S&P 500 has becoming more and more concentrated in these top 10 stocks. And this concentration is sitting at a record high over the past 30 years, with the previous high being during the tech bubble, where the top 10 stocks made up about 27% of the S&P 500. So basically, the S&P is becoming more concentrated in a handful of stocks, and the diversification in the S&P is becoming less and less. All right, this next table right here shows us where the returns of the S&P 500 have been coming from. So the Magnificent Seven so far year to date are up 29%, and they have produced 51% of the S&P's total returns. So the majority of the S&P's returns so far this year have come from just 7 stocks, okay? Now the remaining stocks within the S&P have generated returns of about 7%, and in general have contributed about 49% of the index's total returns. So if you are a stock picker and you do not own the Magnificent Seven, then it has been extremely challenging to outperform the S&P so far this year. Now, it's also worth noting that the Magnificent Seven have been seeing significantly more earnings per share growth than the remainder of the S&P, and they are projected to see more earnings growth over the next 2 quarters. So these 7 businesses are growing significantly faster than the remaining 493 stocks in the S&P, which does kind of make sense as to why their stocks are performing better as well, because stocks do follow the underlying businesses. All right, moving on now. This next chart gets us into the consumer health, and this is the household debt service ratio, which are the debt payments as a percentage of people's disposable personal income. And we can see that the household debt service ratio is currently sitting at 10%, which is actually still below the long-term average over the past about 45 years now. The highest it got was in the fourth quarter of 2007 at 13.3%, and we aren't quite back to those levels right now. And we are actually a pretty far ways away from those levels still. And again, we are actually below the long-term historical average household debt service ratio. However, if we take a look at flows into early delinquencies, we can see that auto loans and credit card loans are ticking up quite a bit, and they are actually continuing to go up. It also looks like the early delinquencies of these loans are actually getting above their historical averages. However, we can see that back here in the Great Recession, these numbers got up to roughly 14%, so they do still have quite a long ways to go, but it is worth noting that the early delinquencies in these loans are trending up in a pretty big way. This next chart shows us the personal savings rate of people in the United States, and we can see that so far year to date in 2024, it's only 3.6%. which is well below the long-term average of 8.5%. So people are not really saving that much money right now, and this is probably due to all of the inflation that we have seen over the past 4 years now. We can also see the household excess savings in terms of trillions of US dollars, and we can see that it peaked here at 2.3 trillion during COVID in 2021 and in 2022 when there was a lot of stimulus going on within the economy. Since then, people have been spending their excess savings, and now excess savings is sitting at $500 billion, which means that it is down about 1.8 trillion from the peak only 2 years ago. And it is going to be interesting to see what happens when people's excess savings do run out, because this trend is clearly going down. So when it hits zero, are people going to be spending less money, or what is going to happen to the economy? That is something that I am interested to see, and something that I am kind of anticipating will happen sometime soon. This next chart shows us the contributors to headline CPI inflation. And we can actually see that shelter inflation is still the #1 source of inflation, However, it has been trending down since about February of 2023. So over the past 18 months, shelter inflation has been trending down, and it still is today. Overall, headline inflation is also sitting at 3%, which is the lowest it has been since June of 2023. And overall, the trend of inflation is coming down. And a lot of people are speculating that this means that the Fed will lower interest rates sometime quite soon. In fact, by the end of the year, the FOMC is estimating that interest rates will drop to 5.1% versus the 5.38% that they are currently at today. The Fed is then expecting interest rates to drop to 4.1% by the end of 2025, and then at 3.1% by the end of 2026. So basically, interest rates are projected to drop by roughly 2% over the next 2 years. And I do think that the market is currently pricing this in. All right, now this next slide shows us the capital expenditures from the major AI hyperscalers. And we can see that these companies have continued to spend more and more money on capital expenditures. And in the year of 2024, they are now projected to spend $188 billion, which is roughly 50% more than they spent in 2023. So the capital expenditures of these businesses are continuing to explode and skyrocket. Now, what's also interesting is the global electricity demand from data centers and crypto is projected to grow by 80% from 2022 to 2026. This means that the world is projected to continue consuming a lot more electricity, and we are going to need a lot more electricity supply to actually power and meet the demand of all of these data centers that are being built around the world, and these data centers that are actually powering the AI revolution. This is something that Bruce Flatt and Mark Zuckerberg have both talked about as well, and this is something that I have covered on my channel before. And it is interesting for me to see that there is so much projected electricity demand, because it's not really something that is talked about in the stock market a lot today, is how these electricity providers could see massive tailwinds over the coming decades. And this is one of the reasons why Brookfield is the largest position in my portfolio. All right, moving on to the international charts now. Here we can see the international price to earnings ratio discount versus the US price to earnings ratio. And we can see that relative to the US markets, the international markets are actually looking quite cheap, with our largest discount in 20 years now by far. So it does look like there could be value found in the international markets versus the US markets right now. We can also see the difference in dividend yields versus the international markets and the US markets. And right now, the international markets are offering a pretty high dividend yield versus the US markets, which could also suggest, once again, that the international markets are looking cheap relative to US stocks today. Moving on, this next chart shows us the global valuations of different markets. And here we can see that the US is trading for that 20.7 forward price to earnings ratio, and its 25-year average was that 16.7. So the US markets are selling well above their long-term historical average price to earnings ratios. Japan is currently selling below its long-term average price to earnings ratios, so is Europe, and so is China. The emerging markets are trading slightly above their price to earnings ratios, and overall, it does look like China is offering the largest discount right now by far. The Chinese markets are trading for a price to earnings ratio of only 9.3, which is an earnings yield of around 11%. And overall, it does look like Chinese stocks are extremely undervalued right now, assuming that nothing major happens to the Chinese economy going forward. This is also interesting because a lot of super investors have been buying Chinese stocks. And even Howard Marks has said he is happy investing in China right now. So while a lot of investors are scared of the Chinese markets or saying that the Chinese markets are uninvestable, a lot of super investors have actually been putting more money and allocating more of their portfolios into Chinese stocks. So we're going to have to see how this plays out over the long term. This next chart also shows us that China is projected to become the leader in semiconductor production by 2030. It also seems like countries are racing to produce more semiconductors on their own. And you have to wonder what this increase in supply of semiconductors will do to the margins within this industry over the coming years. This next screenshot comes from Yardeni Research, so we're actually moving away from the JP Morgan Guide to the Markets now. But I do think that this chart and the following information is very useful for investors to know. So this chart shows us the S&P 500 large cap forward price to earnings ratio versus the S&P 400 mid cap index and the S&P 600 small cap index. And right here, we can see that the mid and small cap indexes are trading for forward price to earnings ratios well below the S&P 500 overall. If we also take a look at these two indexes versus their long-term historical averages, we can see that they're actually selling around their long-term historical averages, if not below their historical averages. Therefore, in my opinion, this data does suggest that there could be value found in small and mid-cap stocks in the market right now. This screenshot was also shared in my Patreon community, which shows the valuations of small cap stocks versus large cap stocks, and we can see that the relative valuation between the S&P 600 small cap index versus the S&P 100 large cap index is at about a 60-year low right now. And the last time that small cap stocks were looking this cheap was during the tech bubble. So all of this data is suggesting that small cap stocks are actually looking quite undervalued right now, and this could be an area of value for investors to seek out. Now, the last chart that I want to show you all was also shared in my Patreon community. And this chart right here shows us that higher valuations equal lower returns. And what this chart is specifically showing us is the S&P 500 forward price to earnings ratio versus its annualized total return over the following 10 years. And you can clearly see that historically, the annual returns lower as the price to earnings ratio of the S&P 500 increases. We can also see that around a 23 forward price to earnings ratio, the 10-year future returns go negative. And as we saw, we are currently at a 21 forward price to earnings ratio in the S&P 500. And historically, when the S&P has traded for this price, the 10-year returns have been around 3%. This suggests that investors should lower their expectations for future returns due to the market currently being quite expensive. Before he died, Charlie Munger was also saying that there could be a lost decade, which is where the index doesn't produce returns for a decade due to the high prices in the stock market today. It's also worth noting that there has been many times throughout history where the S&P has not produced returns for a decade, if not longer. And I do believe that this could happen again. So what my main takeaways from all of these charts are, is that index investors do need to lower their expectations for future returns. There also is a lot of value outside of the US markets and in small and mid-cap stocks. So these could be areas where investors could find undervalued stocks. I also personally think that we are in a stock picker's market because personally, I do not think that the S&P 500 and the indexes are going to produce strong returns over the next 5 to 10 years. And I do think that the large returns will come to stock pickers who can find individual stocks that are currently undervalued and offering significant future growth. But with all that being said, that is going to wrap up the video for today, everyone. And if you did enjoy this video, then please remember to leave a like on it. And if you want to stick around and see more stock market related content like this, then please consider subscribing to my channel as well. As I said, I like to go through all of these charts on a quarterly basis whenever JP Morgan updates their guide to the markets. But that is going to be all for me today, everyone. And thank you all so much for tuning in. As always, I truly do appreciate it, and I really hope to see you all again in my next video.